the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Hey, welcome to another Capital Gains Tax Solutions Master Class, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan, we really believe, is the enemy, right? And using something like the Deferred Sales Trust, a 1031 exchange, a Delaware statutory trust, maybe an opportunity zone, maybe a charitable remainder trust, maybe a donor advised fund. There's a number of ways to avoid paying capital gains tax legally. And we want to help clarify those options and give you some clarity about what might be the best fit for you. I am Joe. For those who don't know me, my name is Brett Swarts, and I am founder of Capital Gains Tax Solutions. We have the Capital Gains Tax Solutions podcast. We're streaming this on YouTube right now. If you haven't subscribed to the channel, please do that. We so appreciate that. Give that a thumbs up as well. That helps YouTube to share the love with helping people to defer capital gains tax. And we're in this together, people. So please show us some of that appreciation. If you find any of this valuable, which I think you're going to, because I am joined by some of the smartest, most coolest, most fun people to hang out with. One in particular is the Jake Miller. He is a certified financial planner. He is an entrepreneur. He is a husband, a father, he travels the world, speaks multiple languages. He used to be in the military. He is amazing. Jake Miller, how are we doing today?
Doing very well, Brett. How's my sound? Can you hear me loud and clear?
I can hear you, but it looks like the video might be a little bit, I don't know, like it's in the Matrix or something. Micah, are you seeing that same thing? Is he in the Matrix?
No, I don't know what you're talking about. No, just kidding. I'm seeing it too.
Okay, cool. Now you're looking good, Jay. Now you're back in the Matrix. But what that means is your video is kind of going to like this white screen. I don't know. It's kind of cool, but so we'll work with that as we go. But I also see the Rebecca Munson. She's one of our strategic alliances, part of the EXP family team as well, up in Truckee and Tahoe. Rebecca, how you doing? Long time no see.
I know, doing well. Yeah, if you hear a little yipping in the background, we just got a puppy. So I'm in charge of the puppy care today. So
excellent.
keep it on mute.
And Rebecca's on her way to becoming certified as a deferred sales trust real estate agent. In fact, I'd say she's already there. We just have to make that official, meaning that she understands the nuances to the extent to help you get going on your exits. If you're selling a highly appreciated primary home or second home, vacation home out in the Tahoe, Truckee area, then you want to look her up because she can help you sell and work with our team to help you exit and do it all very smoothly. Jake Miller, I'm going to test you again, man. How is the matrix over there? Can you hear us?
Recording in progress.
Yes, I can.
Okay.
Yep.
Maybe you do no
Everything's
video.
really good. Just trying to get the whole video thing. I might be joining with a second device to get the video working.
Well, it's
But
working there
hey.
now. So you look good. And I like the hat, although I missed the hair. But you get double Jake now. That's kind of cool. Do you have Pierce York in the house? Pierce, are you here? No, that's cool. I think it's just 4 of us. Awesome. Well, this is going to be fun. So today we're talking about some of our options, right, that we have. I think it's good to know what options are available. And then it's good to also tell a couple deal stories that have happened recently, also some live sales that are going on, and then just answer questions for everybody that might have questions. That being said, Jake Miller, what else would you like to add to this intro?
Hey, I know that we have some people watching today who are selling or thinking to sell part of their business. And so with that being said, I want everyone out there, whether it's real estate, whether it's, highly appreciated stock, if you have a business that has been going very, very well, and you're thinking of letting some new owners in and maybe buy some of that stock, whatever it is that you're doing, if you're selling a highly appreciated asset, now is the time to tune in, hear what can be done. Rather than chipping away up to 1/3 of your gain of your appreciated value in your asset or your business and send it off to various government agencies, let's talk. Let's see if maybe we can't do something else that is more optimized.
Perfect. So its first thing is to define the goal, and sometimes that's just actually defining the problem. Like A is where you're at, and B is where you're trying to go. And so what's the goal? The goal is capital gains tax deferral. The goal is growing your wealth. The goal is being a good steward with your wealth. The goal is, slowly retiring from the business or retiring from the business altogether. It could be building a legacy and a wealth plan to help with what your vision is for your wealth for the next generation. It could be a number of things. It could be downsizing from that house. Whatever that goal is, the more you can clarify it and the more you can define where you're trying to go, the clearer it'll become which path you should take, whether it be, again, the 1031 exchange, a Delaware statutory trust, a deferred sales trust, or a few others that are out there that are very well proven and legal to help you avoid, defer capital gains tax. In other words, be very tax efficient. So that's the goal. The next thing would be, what are the options, Jake? So for those who are out there considering different options, what might somebody do, and why might the deferred sales trust be that better solution for them?
Yeah, so Brett, what are the steps? What are the options? Essentially they can sell their property, do the normal thing, pay the tax. If it's a piece of real estate that they haven't lived in it, and if it qualifies for 1031, they might be able to have a 45-day window, 180-day window by which they can transact and possibly have a streamlined process. Should that not work for them because the market for selling is not the same market for buying, or should that not work for them because it's not a like-kind house or piece of real estate, or should it not be a piece of real estate at all if it's a business, or if it's a house that they've lived in, or if it's appreciated stock, what have you. If it's any of these other things and you want to have more control over the timing, then a deferred sales trust might be a better fit. Simply because, as David Young said in the video in the very beginning, it puts the power of timing back in your hands so that you can decide if and when you take distributions to live on that are then taxable, or you reinvest the assets and everything that you're reinvesting continues to be deferred going forward.
Absolutely. And the cool thing about the deferred sales trust as well, that we absolutely love, it's not just a deferral mechanism, it's also a cash flowing producing machine if you know how to unlock the options within the deferred sales trust. And the term that we use here at Capital Gains Tax Solutions and Jake at Strategic Tax Solutions is lendership. And lendership is just the idea that at first you're a lender to the trust, but then you can become an owner of a new LLC that partners with the trust. Okay, so step one, sell and defer the tax, funds go into the trust. Step two, you can form a new LLC and you can joint venture partner with that LLC, which means there's additional upside that you can still earn and grow and capture, right? Versus just a lender, you're just fixed at a certain return on the investment. So that's pretty cool and it's pretty exciting. I'll give you an example of that. A client sold a business for $2.6 million out of Alabama. He partnered with his trust to build 70 multifamily units in Tennessee. So we call this the go fund yourself strategy, as well as another way to think about it, where instead of getting funding from a bank or funding from another investor, the trust, which owes you the money, which typically 25 to 50% of it, depending on the gain, is subject to capital gains tax, but you're paying zero to the government to as long as you're below certain limits per year. And you can use the money to go invest into more real estate. So it's pretty cool. So it's kind of like an interest-free loan from the government, legally able to do this if you follow the rules and work with those who know how to do this. It's part of why, if you're curious, that's what we do at Capital Gains Tax Solutions. We are a trustee, and then we work with a financial advisor, particularly Jake Miller. If you're listening to this video right now, who's the financial advisor, and we work with commercial real estate entrepreneurs, people who are selling stock, businesses, to defer the tax and to execute on the game plan. Because Jake, it's not just about what it can do for you and how it works. It's actually the team of professionals to help you execute that. So Jake, talk about that execution and the importance of that. And number two, the legality, because someone might say, wow, man, this sounds really cool, or maybe even too good to be true. Like, what's the legality behind all of this?
As far as executing this, we kind of need to be in front of the deal. This is not one of those retroactive things, right? It is possible that perhaps we can come in and save a failed 1031. However, under most circumstances, we want to be in front of the game or in front of the deal, in front of the close, right? Operationally, we come in from like a CFO standpoint, talking about the financial aspects of it all. We come in from like a trustee standpoint. That's Brett Swarts, right? And then we bring in the tax attorneys. We analyze the deal. We make sure that everybody's eyes are wide open going into this thing, that they know what it does do, what it does not do, right? And then mechanically, we form the trust. It's all set up, ready to go. We transfer asset into the trust. The trust sells whatever the asset is for the gain, right? And because the trust receives it and the client doesn't, there's no tax owed on behalf of the client. We've essentially pushed the transaction out of his arm's length, so to speak. And for tax purposes, it's not recognized during the tax year until that client takes distributions from the trust down the road, which most clients, Brett, are using the trust to reinvest. And so when they're pushing things down the road, they're effectively pushing things down the road, deferring those taxes and able to reinvest with the bulk proceeds minus some attorney fees rather than, net of taxes, which sometimes are 20 to 30 to 40% of what these clients are taking home.
Yeah, I think of like a delayed tax trust. Another way to think about it, right? So in the deferred sales trust, you're delaying the tax. Think of an IRA like a delayed retirement plan. You're delaying what you would have paid of tax if you're doing a regular traditional IRA until a certain age where you start taking distributions, at which point you'll be taxed. But in the meantime, the interest in the gains can grow, tax deferred. It's really cool, really amazing. Rebecca, there's a thing called a 121 exclusion, and someone might be curious, hey, I had this primary home. I bought it in Tahoe for $1 million. It's now worth, let's say $10 million. They bought it 30 years ago. It's right overlooking, Heavenly or North Star, and it's just incredible. So talk about this 121 exclusion if you lived there 2 of the last 5 years, and if you're single versus you're married.
Yeah, so the 121 exclusion is an awesome one of the benefits that the U.S. government has given us for primary homes. $250,000 of your gains can be gains can be tax-free if you're single, and $500,000 if you're married or filing jointly, I guess would be if you have a partner. And you have to have lived in the property 2 out of the last 5 years. So yeah, it's wonderful. My husband and I have taken advantage of that every 2 years for the last like 20. So
Absolutely. And that's honestly, that's the best thing. If you've lived there 2 of the last 5 years, it's tax free. There's no trust to set up. There's no 1031 to go into. It's a beautiful thing. I mean, even if you lived there for 1 year, rented it out for 3 years, and then lived there the last year, right? It's 2 of the last 5 years. You can sell it and you get the opportunity to be tax-free for up to $250,000 of your gain. If you are single, 500 if you're married. So let's do a kind of quick scenario. Let's say you bought a house for $1 million and it's worth $2 million and you've lived there 2 of the last 5 years. How cool is that, right? And you're married. You have no tax on the sale. It's incredible, right? Now let's imagine though, we're back to the original scenario.
Right? But don't you? You do.
Oh, I'm
right?
sorry. You bought it for 1.5 million. I did the math wrong. I'm sorry. 1.5 million. Good catch, Rebecca. I was testing you. See, I was seeing you testing you on the math there. So you bought it for 1.5 million and you sold it for 2 million. Then you have your 100% tax free, which is incredible, right? But what happens when you bought it for $1 million? And then let's say it is worth 10 million. I mean, it's a big number, but in fact, we helped a client out of Palo Alto who actually bought a property for 6 million, sold it for about 8.5, and he was single. So his 6 million included that $250,000 121, but he still had 2.5 million of gain. Well, in California, it's like 37%, which is crazy on the gain, right? So 2.5 million times 37%, he was looking at $925,000 of tax. Now back to the deal, let's say it's in Tahoe, he bought it for $1 million. And let's say you're married. So now you're going to add $500,000 to the basis. Okay. Which is cool because you built there 2 of the last 5 years. But if you sold it for $10 million, you take the 10 million minus the 1.5, that's an $8.5 million gain, right? Ouch. Now times that by 37%, state, federal, Obamacare, that's $3.145 million of tax liability if you sell. Unless, of course, Rebecca, you have the Deferred Sales Trust. So walk us through the scenario if someone wanted to take advantage of that.
So if somebody wanted to take advantage of that, when they're even just thinking about selling the property, they should reach out to myself, the Deferred Sales Trust, and, deferred, capital gains tax solutions. And let's sit down, have a conversation about what their goals are, moving forward. How long have they lived in the property, what they want to do, and then let's figure it out. Timing wise, definitely beforehand.
Yeah,
and then
plan your exit plan before you list and sell the property. Because guess what? Not every real estate professional has the same solutions for you. Not every escrow company knows how to do this. In fact, we also have a DST co-host of the podcast, Pierce York, who's also with EXP, and he sells luxury homes down in Newport Beach and also commercial real estate. Pierce, he is the DST man on the street today. He's got the glasses on. Can you hear us okay? And talk to us, Pierce. What's on the street today down there on the beach? Where's the pina colada? What's happening down there?
No pina colada today, man. On my on the work. So there's 2 properties right now on the sand that are being sold. We have a buyer who's looking for a property on the sand down here in the Newport Beach area. Their budget's up to 12 million. So I'm going to look at a property that they love. The problem is that these people just built this property and it's for lease. It's not for sale. However, I'm calling the agent, who happens to just be one of my friends. And I was talking to them and I was just telling them, look, what would be their number? And they said 15 million. Well, that's too much for, the buyers, but the buyers are willing to go 13. So I was like, look, what if we could do 13 and defer all their tax, reinvest their proceeds? She's like, well, let me talk to them to see if they would be interested in that. So I'm going to check out the property right now. It happens to be right down the street. So that's currently where we're at. I I got to figure out a lot of stuff. What's their basis? How much did it cost them to build it? What they buy the lot for? So I'm doing my fact finding and gathering right now and looking at the property, but we can put it together. It'd be good to go. The other property is...
Well, pause right there before you go into that one. I want to bring Jake back in. So Jake, it's not always about what you can sell it for. It's what you can net. And oftentimes, sometimes these sellers, Jake, are just thinking that they have to pay the tax. So walk us through that ROI. And I don't know what they built it for. Let's just say they built it for 5 million, Jake, and it's worth 13 right now, and they're in California. So I like people to hear the ROI from your perspective.
Absolutely. So let's say the adjusted basis, just like you said, hey, they built it. It's worth 5 million. That's the adjusted basis. It's worth, I apologize. What they have into it, their cap, that is the 5, right? That's their base. The 13, take the 13 minus the 5, the sales price minus their base, right? So you've got 8, fantastic. So now we're looking at the state of California. We're looking at federal capital gains tax rate. Federal capital gains tax rate is 20%. Let's add 3.8 to that 20 because of the Medicare tax. Very likely you're going to be subject to that. So now we're at 23.8. 23.8 plus the state tax, state income tax. Why state income tax? Because the state of California does not recognize a preferred capital gains tax rate at the state level. So the maximum in the state of California is 13.3. All right. So if I get my little trusty dusty calculator out.
I already did it for you. It's 2.96 million.
2.96 million in taxes, right? Okay. So that's pretty rough. That's pretty rough. Is that enough tax paying, Brett, for us to maybe consider an alternative route where we can reinvest all 8 or 8 minus a little bit of attorney fees rather than 8 minus 2 point how much million?
Yeah, 2.96, like 3 million. If you think about it, they're asking, he said 15, you hear that? And then one wants to pay 12, 15. Could it be that they're already accounting for that 3 million, which is the difference in tax? And I don't know what their basis is. I don't know what they're in it for, but these are the real life scenarios where someone might say as a real estate agent, hey, would you sell it for X? And they're like, no, we'll dig a little deeper. Why are you hesitating? What is it about 15 that you want? Well, after closing costs, paying your commission, after paying my tax, I'm looking at netting 12. I'm assuming they own it free and clear or whatever, right? And you go, well, what if there's a way where we could defer that capital gains tax and help you net a higher number at closing, right? Even though you might need to take a lower purchase price. So Pierce, I'm going to bring you back in now. Do you happen to know what the real numbers are there, or are we kind of, are we pretty close to what's going on over there?
Here's what I know. I know that there was 2 lots purchased at $8 million total. So if I divide the lots in half, I'm pretty confident that one lot could justify $4 million for the actual land. I know that it cost them over $1,000 a square foot to build. I'm assuming it's around $1,250, just based upon what the realtor told me. It's 4,500 square foot home. So I'm looking at probably around 6 million or so to build, and give or take a million or two in either direction. I don't have the exact number.
Yeah, no, we'll use 4.5 million. 4,500 square feet times 1,000, that's 4.5 million. And then we'll use another
over 1,000 because it was in the height of the inflation. Right. So
let's call it $9 million, right? $9 million is a good estimate there. And if we're taking, if it were 15 million minus the $9 million, that is a $6 million gain times 37%. That's $2.2 million. So I think we're all pretty close. The key is it's multiple millions of dollars of tax that they would pay.
Right.
Now, Pierce, I wonder if you know this, why wouldn't they just do a 1031 exchange, right? What comes to mind here? Like why not just sell it at 13 or 14 or 15 million and just 1031 exchange, Pierce?
Well, I mean, they honestly, they could. It could be a viable strategy for them, and that's kind of what I need to figure out and what I'm trying to do. But what I do know is that
hold on, can I coach you real fast? Could I coach you real fast on why they might not do that?
Mm-hmm.
Well, I have good reason why they shouldn't, but I think that would be because there's a lot of stuff that comes with that. You got 45 days to identify. You got 180 days to close. You got to go find a new property, right? Like there's a lot of stuff that could absolutely make it difficult to do that. You don't want to be a motivated buyer, especially today. They own the property free and clear. It doesn't make sense to go and find another property to 10.
Maybe not, right? Maybe not. So the key is to
maybe
ask them,
not.
Yeah, the key is to ask them and just say, hey, would you consider 1031 exchanging? If so, why or why not? I'm going to bring Rebecca back in. So Rebecca, you and your husband have been building in Tahoe and Truckee, and you've been selling real estate for years and years and years and years. As a developer, from a developer's standpoint, why wouldn't somebody want to do a 1031 exchange who's in the business of developing at 13 million? Walk us through that.
Jake might have to chime in too, but it's my understanding that as a developer, it's a business. So you're selling a business. And so it may not even qualify for a 1031 exchange because it really hasn't been a rental property, unless they have leased it for a certain amount of time. So it's
there's some good insight there, right? So if it's more or less than a year, right, is the first thing. What's the time frame? So Pierce, you want to know that? Keep going, Rebecca.
So there's all those things involved as well. And timing and everything, they may not want to continue on doing what they're doing. And
Jake, do you want to add to that real fast?
Yeah, I mean, simply as Rebecca mentioned, even though it's in real estate, it is a business and it's a development. A lot of times it's land movements, right? And nobody 1031 just land by itself, etc. So there's a lot of moving parts here to where normal solutions that are mainstream media solutions, that means that any accountant knows about them, may not be the solution for something like this. It's something bigger, something a little bit more complicated. You might need something that's a little bit more tailor-made, like a deferred sales trust, which is literally by its name built to defer the recognition of the sales date forward. And that's what we're doing with the deferred sales trust when people are selling now, but they're not having to recognize it now for tax purposes.
Perfect. And so it works for businesses, it works for real estate, crypto, stock, okay, LLCs, S Corps, C Corps, veterinarians, dealerships, crypto. Yeah, really anything. Here's the other one I was getting at as well. So if they're in the business of development, Pierce, right? This is why it's so important to be in discovery and find out what they had intended to do in the beginning and what they intend to do for their outcome. In other words, where are they at now? Where are they trying to go? And if they're in the business of development, if they bought the land for basically 4 million per lot, well, if they're selling at 13 million or 14 million or 15 million, are they wanting to just go buy a bunch more lots at 4 million a lot, or are they probably wanting to invest and need some capital, especially with interest rates going so high for the cost of capital to construct? They're probably not wanting to overextend themselves or even go into a regular 1031 and overextend themselves and take on more debt or whatever that might be. In a 1031 exchange, in other words, it's very restrictive. And I'll give you an example. We just did a deal in San Diego. And this was a car wash. And I'm going to pull up the little paper here with the little flyer. And this car wash was about a $13 million sale. It was 12.75 right around there. And they found an old taco stand. This used to be just vacant lot here, vacant land. It was just a little small taco stand. And the land and the taco stand was worth not much. So they said, look, tell you what, Mr. Taco Stand guy, we want to buy your land. But we want to put your taco stand, we want to 10x the business. We're going to put it inside of the car wash, and you're going to have all kinds of business all day because we're just going to run through car washes here, and it's going to be amazing. It's going to be really nice. How about we buy your land for X? I think they gave him like $500K, but then they put them inside of there, and then they built the rest of the unit for about 3.5 million. So all in, they're in it for like 4 million. And then they owned it for more than a year, right? And they're looking to sell. They weren't even looking to sell. They just got a call. But guess what? 13 million basically minus about 5 million. That's a huge gain, about $8 million. And they're saying, oh my gosh, I'm in California, state, federal, Obamacare, 37 to 40% with depreciation recapture. And I said to them, well, why not you just do a 1031 exchange? And they said, Brett, first of all, we have one partner who's ready to retire completely. And that means the whole entity's not moving. So we need to do the 1031 completely. We don't have time or energy for the drop and swap. And even those are being challenged by the Franchise Tax Board as illegitimate. Number two, We're in the business of developing real estate, buying land, vacant land, adding value on top of it, and then selling it. But the land that we buy is typically around 500,000 to $1 million. And then we're putting capital into that. We don't like taking on a bunch of debt from a bank. And he goes, so we want to go buy 3 or 4 more projects at 500 each, put $2 or $3 or $4 million on each of them. And the Deferred Sales Trust gives us that opportunity to do that. It allows you to be debt-free, diversified, liquid until you're ready to strike when the iron's hot. Pierce, you want to add anything to, or bring you more context to the deal we're talking about here?
Yeah. So I mean, at the end of the day, right? There are times when I just kind of wish the 1031 would just kind of go away. And I'm not saying that because like they're not useful in some situations, because there are situations where they are useful, but they are much more of a burden than they are of a solution. They are so restrictive in so many different ways. These people happen to own the property free and clear, you know? So if they would have to go do 1031, they gotta go put debt on something, you know, like if they're going to do that, like it doesn't make any sense. So, you know, there's a lot of different things that you got to do for the 1031s. And it just, everyone thinks it's like the answer, and it's like a C out of, you know, it's just
Blockbuster. Yeah, it's Blockbuster.
It's just not that good.
And they wouldn't have to put debt on it as long as they purchase something equal or greater value. Now, if they had debt, they'd have to replace equal or greater debt. But the fact that they are free and clear does simplify that one piece of it. Just FYI. But to your point, is it really solving what they're trying to solve? And this kind of goes back to our original premise of this entire capital gains tax solutions mastermind or masterclass is, what's the goal? What are you trying to do? Where are you trying to go? What are you really trying to do, and why? What's the reasons behind that? And what I like to do with clients or potential clients is just have them draw on a piece of paper a line down the middle and put 1031 exchange versus the Deferred Sales Trust, and just figure out which one fits. In fact, I want to bring in Jake Carpenter. We actually just recently did a deal for one of his clients who did this exact scenario, sold a $10 million portfolio of mobile home parks out of Idaho. And Jake, what was it like for Gary when he was considering a 1031 exchange versus the Deferred Sales Trust?
Well, he was actually, I mean, he went through the gamut of what kind of opportunities he might want to consider outside of the Deferred Sales Trust. And that's why he truly became an advocate for the Deferred Sales Trust, because he took a look at everything else that was out there. And the unique situation with Gary was, he was in a situation where he had a lot of debt over basis, and we had no zeros that at the time that was available. So in a short period of time where we didn't think there was a zero available to take up all that debt over basis, we were scrambling and looking at 1031 exchanges, multiple other things, possibilities. And once he went through the checklist of, okay, 45, 180-day window, it's got to be at equal or greater debt, it's got this, that, the other, the stars have got to align, you know, and it was just, you know, after the deal got done, we get tons. In fact, I've got 3 referrals from him just in the last couple of days. I mean, you know, it's just crazy. But people have to sit down and go through a due diligence process and go, okay, what do I get with a 1031 exchange? Rebecca, that was a great thing that you brought up, because a lot of times we're talking about business sales, and business sales don't qualify for 1031 exchanges. And then we got to fit ourselves into the size 2 genes, you know, 180-day window, 45-day to identify, versus the Deferred Sales Trust, which has a lot more flexibility. So it's a process. That process is really valuable.
So good, Jake. Yeah, and it's such a great, such a great story and a great outcome for Gary, and did such an amazing job. In fact, Jake Miller helped to source and find the Delawares and work together all as a team to do a great job. And Well, we also have Micah on. I'll bring Micah in. Micah's like post-close to help with cases as well. Micah, how is it working and going through, all of the moving parts and, making sure to try to bring everyone together?
It's really kind of fun because there are a lot of different moving parts. There are different situations with every different person, and everyone brings their own little area of expertise. And it's really neat to see it come together for that one person to help them save so that they don't have that capital gains nightmare.
Yeah, absolutely. And so it's like we each have a shield and a little spear, right? Like the Roman legions. And, they all lined up together, their shields kind of, and that's kind of how, and the client's there, and we're all working together to try to help them, achieve their outcome that they're doing. And that's where we all come together. This is why we're here. So we love it. So we are grateful for the U.S. government for having high capital gains taxes. Otherwise, none of us would be here or maybe even know each other. So thank you, Mr. Government. And so that being said, we have some new guests here, and I want to give them an opportunity to say hello. I think they're just coming in now and ask any questions. Looks like there's Carol. It looks like there is Cheryl. Looks like there is a Team Squared, which is cool. And does anyone have any questions or thoughts? Anything we just said, or just in general, we want to say hello. We always love bringing new people into the mastermind.
Hi, Cheryl here in Texas. Question. Hi.
Hey, Cheryl.
So I've been trying to hop into these for a little bit there to understand how to better explain it to my client. We're looking at doing a $6 million purchase of a pre-planned, 6.5 actually, pre-planned development. The water has been drilled, engineering plat laid out. 3 million will be in coin, and then 3.5 will be cash. So do you have a suggestion for the seller receiving this combination with the deferred sales trust that I might suggest?
I'm gonna let Jake start off since, and then I'll follow up. Go ahead, Jake.
Very good. So there's two things that we need to look at. We need to look at it from the eyes of the person receiving the money and from the eyes of the person paying the money. You presented a little bit from the aspect of the person paying the money. It's going to be part cash and part something else. You talked about coin. Is it Bitcoin or is it a different coin?
Yes.
Bitcoin. Wonderful. So, all right. So that's kind of like somebody, let me just change it because a lot of times people think of Bitcoin as money or something like that. But let's just say that somebody's going to buy ownership in a business. They're going to do it with cash and they're going to do it with inventory. And that's kind of the same scenario here. The inventory has a value. And Bitcoin is really easy because there's a market for it. There's a daily value attached to it. So we can easily say, hey, cash and a value of Bitcoin coming in. And what's being sold exactly? What is it that is being sold?
Like I said, it's a 105 acres platted, the city, everything curb and sidewalk, 2 wells drilled to 520 feet, and the water will also be resourced back out.
It's a ready to go development. No houses, right. But the streets, the
ready
curb,
to go. All engineering plat, everything's done, ready to go.
Fantastic. So the individual who owns the development,
right?
The individual that would put together a deferred sales trust. And the deferred sales trust could sell, of course, to these individuals who want to trade something, an asset, Bitcoin, and cash, which can be received by the deferred sales trust. Now, Brett has extensive experience, more than any other trustee that I know, in working with crypto. I almost came out in Spanish, criptomoneda, like, the cryptocurrency, right?
Yo hablo español también, está bien.
Pues genial. Vamos a empezar así entonces. But Brett has worked with Kraken and I think at Gemini and a few other exchanges to set up wallets in the name of the deferred sales trust to receive and to sell cryptocurrency. And so that has been a common practice that we've actually refined, where I want to say as a team, we're known, especially with Kraken, we actually have a point of contact that assists us with these types of transactions. in the name of the Deferred Sales Trust.
Okay.
Yeah. So step one is obviously a opportunity just to sit down with the sellers, right, who are looking to sell, and walking through with them their options and understanding their goals. And should they choose the Deferred Sales Trust, step two would be to sign a conditional engagement agreement with myself and Jake and the tax attorney to kind of go through and build out the opportunity for that particular client. And then this particular trust is a single entity business trust that only will do business with the seller. And so what Jake was saying there is essentially the asset, the 100 plus acres, will be actually sold to the trust first. And then the trust itself will ultimately sell it to the buyer, and the buyer who's putting in Bitcoin. It's interesting. We haven't done a scenario where Bitcoin was the capital that was going in. So this actually will be new. We have done when someone has had the Bitcoin and was exiting into the Deferred Sales Trust. Oh, this is the cool part about what we do. We bring in the tax attorney and we figure all of that out, and he figures that out, and we follow his lead because he's the one who's created it. By the way, thousands of closes, billions under management, over 26-year track record, over 20 no-change IRS audits. They provide lifetime audit defense for anyone who's wondering. So it's been done in just about every type of asset you can think of: public stock, private stock, cryptocurrency, Bitcoin, Ethereum, LLCs, S corps, car dealerships, real estate companies, of course, real estate itself, optometrists, everything you could think of. With that being said, they've also been all kinds of different partnerships and different structures. I've never not seen them have a way to solve it, but I am very curious to see, since Bitcoin is coming in, how they might structure it. But I'm confident that they would have a way to do that. Upon the final sale, the smoke clears. The seller in this scenario would be given a promissory note, and the funds would have gone to the trust. And at that point, they're due back a payment over a short period of time. But the neat part is they're able to defer the capital gains tax, maybe $1 million or $2 million, depending on their basis, right, that they can live off of. In this scenario, since Jake and you guys are working together, Jake would be the financial advisor to manage the capital and help build an allocation out for the note holder, and we'll work with me, the trustee, to put it all together. So that's kind of the really 3-minute version, but any questions on that?
I don't know. Think I got it.
Okay, pretty
Thank
cool. Excellent. And now timing is very important. Do you know when the sale might happen?
Working on final details. I'll let you know next Friday.
Sounds good. And so we would also encourage anyone's listening, right? So the signatures of things are when things start to move forward. Ideally, you sign conditionally with us, meaning it's 100% conditional before even a listing agreement is signed, but definitely before the buyer removes all contingencies, because that can create what's called the point of no return. So we want to make sure that you do that before, unless they're going to a 1031 exchange and you're working with us to connect you with our strategic alliance who allows the Deferred Sales Trust as a backup plan. All that being said, we work at no cost, no obligation. I know that sounds like a lot, and it is a lot. That's why you want to get with us early and we can talk through it. Thank you for sharing that deal and that opportunity with us. Does anyone, Rebecca, Pierce, Jay, Carpenter, or Micah, have questions or thoughts on anything that was just said? If any of that was not clear, now's a great time to bring it up.
Brett, I think I would just add that, and you brought this up earlier, not only is it the sales transaction that we're worried about, but the maintenance ongoing, and you introduced Micah and the team and everybody else, but it's incredibly important because a lot of these entrepreneurs that we're working with, developers selling developments, etc., they're looking forward to the next project. And so life does exist after the sales day, right? I mean, we do oftentimes with these serial entrepreneurs continue from one project to the next project to the next project, and utilize the Deferred Sales Trust as a tool that allows them, instead of chopping their piece of pie up into many pieces for the taxing agencies, each time that they have a sales transaction, they're able to actually maintain most of the pie together and continue to reinvest. And that is the main purpose of this business trust, is to allow individuals to reinvest, have control over the timing of when they do take distributions for personal things, and to continue to have more and more projects in the future to diversify their assets and to continue to build.
It's a great thing. It's a beautiful thing. Pierce, do you want to add anything else to anything we just said?
No, I think that was a really good summary.
Did you have a second deal, Pierce? That I know I cut you off because you had so much to say on that first one, and we kind of went another way. But did you have a second deal? Do you want to run by real fast?
Well, the second deal was was interesting, and it's actually a deal that doesn't work, and the reason is because the the person died, and so the kids inherited the property, but it's in a trust, and they got a stepped up in basis, right? So that was an avenue I was trying to do, right? But they don't have the need. So
Yes.
that was after some due diligence, right? And so, and I think the point of that is we're kind of the first ones to say like, hey, like this isn't a good fit for you. It's not like we're just out trying to get, greedy and everyone's thing. Like there's some people that just, this isn't a good fit for. And so like, it's just kind of part of the whole character of the team. And that's just something I kind of wanted to touch on.
Yeah, appreciate that. Yeah, exactly. We spent a lot of time trying to talk people out of it. And here's a couple qualifiers too. Our minimum size deal is 1 million net proceeds, $1 million gain. And you can apply for a free consultation if you have at least $1 million net proceeds, $1 million gain. Unless you have two assets at $500,000 each, then you can combine those two to make one. We do that because it's got to scale. The ROI is going to make sense. And so that's what we found to be a home run, no matter what state, no matter what you're selling. $1 million net proceeds, $1 million gain. So you can learn more about that at capitalgainstaxsolutions.com. You can also learn more about Jake Miller, who, by the way, will be in the new book. Guys, I think I'm changing the title, by the way. I think I got to do it, and it's going to be a long title, but what we do can kind of be long, right? So you see behind here, it says Capital Gains Tax Solutions, right? And you see this, building a tax deferred exit strategy. For those who you're listening, we're on YouTube, you can check it out. But think about saying building a capital gains tax solution plan, exit plan. I know it's long, but I just feel like tax is just too general, everybody, too broad. Like tax can go 10,000 different ways, but once I do capital gains tax, it specifies. Don't kick me in the shin, but Rebecca, what do you think?
I like where you're going with it.
There we go. That's a thumbs up. All right.
Yeah.
Jake, what do you think? Carpenter.
I like it.
Okay. Micah, Jake Miller, the Millers. What do the Millers think? If you didn't know, by the way, Micah and the Jake Millers they're a couple there. They're married.
Building a capital gains tax exit solution, something like that. Yeah.
I know that one's long. I was thinking building a capital gains tax plan
Plan or exit strategy.
But because if I go exit strategy, Jake Miller, it goes longer after that too. Then I'm like really like kicking myself in the shin.
Yeah. I mean,
Out. That's short.
not to throw something completely different in the mix. I like both of the ideas, but defer your tax, grow your wealth.
Defer your capital gains tax, grow your wealth.
The only thing I would add is you kind of like eliminate the whole estate tax thing, which is kind of like the elephant in the room.
It's true.
So if you could patch that in, because isn't that like
That's another book.
That's my second
Maybe
book,
it is.
Pierce. Don't give out the sequel, man. That's like Terminator 2.
Hey, there it is. Okay.
It's gonna happen in Terminator 1. But no,
Okay. If you're gonna write 2 books, heck yeah, I'm all for it. I just want to make sure that you don't eliminate that little piece there, because that little hitter might be real valuable.
That's a good point. It could be a kind of subtitle, but I like where Jake Miller come from. So this is why we mastermind, can figure this stuff out. So to be continued. To be continued. Yeah.
Capital gains tax deferral for those that want to take the red pill.
Is it the red pill or the blue pill?
For those that want the red pill.
Yeah.
Yeah.
Should I do man on the street and just take a poll really quick on 2 people?
Yes. No, because we digress. Okay, so Jake Miller, if people want to find you and Micah, where can they find you?
strategictaxsolutions.com. There's a little booking or appointment right here, right now. 1-800-773-1848. Give us a call, schedule a time. We'll review your deal. And then, of course, introduce you to Brett if it, makes sense for the whole tag team, and then on to the attorneys like we do. We have this process, right?
Fantastic. Pierce York, if people want to find you, where can they find you, sir?
You can find me at kingdomluxuryrealty.com or the YouTube channel Living in Newport Beach, California.
Fantastic. Jake Carpenter, if people want to connect with you, where can they find you, sir?
Carpenter Capital, you can call Sarah at 509-591-9900.
Fantastic. The Rebecca Munson, if people want to sell their luxury Tahoe home, truckee home, anything around like Tahoe, where can they find you?
So RebeccaMunson.com, or they can call me at 530-448-9740.
Amazing. I want to thank everybody for hanging out with us. If you stayed through this whole video, man, that was great. Come hang out with us. You can actually join this master class by going to capitalgainstaxsolutions.com, and you can register to join us and hang out, bring your live deal, bring your objections, bring your hesitations, bring anything to the table. In the mastermind class, we're going to try to help you get some clarity, help you get some confidence, and have a plan, because really that's the biggest enemy. Not having a clear plan when you're exiting your assets can really put you in a tough spot. And we want to help you get clarity and help you to grow your wealth and all of the above, get the freedoms that the Deferred Sales Trust can offer, or maybe a different strategy as well. So appreciate you listening out there and watching. Please rate, review, subscribe. Please give it the thumbs up. Please share this with somebody who could help change their exit plan. Thank you so much. We appreciate everybody. And we'll talk to you again next week. Bye, everybody.